Hello and welcome to today's webinar. My name is Charlene Young and I'm a Senior Technical Consultant here at AJ Bell. Today we are going through an introduction to trusts. Just a quick bit of housekeeping before we begin. Feel free to ask questions at any time during the presentation today. Please use the question box within the control panel, and that should be showing on the right-hand side of your screens. These questions will be picked up and answered via email after today's presentation. Likewise, any kind of technical problems with today, please report them in the question box as well, just so we're aware. After today's presentation, an email will be sent out to you asking you to fill out a feedback form. Following that, you'll get a copy of your CPD certificate and the slides via email as well. Also, a quick note, we will be producing an advisor guide to go with today's session. That will be able to be found on the technical section of our website. So please do have a download of that. It will contain everything we've covered today and a few more details on some of the calculations and tax stuff especially. And a final note, the content of today's webinar is for a professional advisor and paraplanner audience. So, today's webinar, there's 4 sections that I've split our time into today on trusts. Firstly, we're going to begin at quite a high level, just covering the what, the why and the who when it comes to trusts. Moving on, we're going to look at the duties and responsibilities involved in being a trustee. And then we'll get onto the main types of trust, their features and uses before getting stuck into how they are actually taxed. Okay, so let's start at the very beginning. What is a trust? Why might somebody make one? And who is actually involved? Okay, so firstly, the what. So if I was to define a trust, I'd probably say it was the formal transfer of assets to a small group of people, or potentially a trust company, with instructions that how they hold those assets for the benefit of others. There are different types of trusts, as we'll come on to today, and they are, of course, taxed differently. A trust can be made in somebody's lifetime, so to take immediate effect, then it's usually evidenced by trustees, that I'm sure many of you have seen before. It can also be created on or shortly after death, and then the trust provisions will be set out in a will or similar document. The trust document or will state what comprises the trust property. When I say trust property, if it's easier to think of trust fund, then that's absolutely fine. Who's going to be responsible for looking after the gifted assets, so the trustees, and who is to benefit, so the beneficiaries. The deed will also contain kind of any rules or conditions to which the trustees and beneficiaries must adhere. So that second point there, separation of legal title and beneficial ownership. So at the point the assets are actually transferred to a trust, legal ownership of those assets will transfer from the settlor, so the person setting up the trust, we'll talk about these people in a bit more detail shortly, to the trustees. The trustees have an obligation to deal with the property or the fund for the benefit of these nominated persons, so the beneficiaries, and for this reason the beneficiaries are deemed to have beneficial ownership of the trust property. So this means that they, the beneficiaries, and only they, not the trustees, can benefit from the property in the trust. So wherever you see this separation of legal title and beneficial ownership, a trust arrangement effectively exists. Again, in this relationship, the trustees own the assets, they've got the legal title to the assets, but they're not allowed to benefit from them as trustees. Instead, they have a duty to use the income and capital for the trust for the benefit of the beneficiaries. This is kind of why it's called a trust. The trustees are in a position of trust. They have a duty and they have responsibilities to protect and secure that trust property and use the assets of the trust as instructed by the trust deed for those beneficiaries. Okay, so we've covered the what, and now we're going to move on to why somebody might create a trust. So if we go back one step and consider somebody making an outright gift to another person, so no trust arrangement involved, that new owner, after the gift, would assume all the rights over the property and can deal with it however they wish. This helps us to kind of consider why someone might instead create a trust. either to protect assets while they're still alive or to pass on assets when they die. So, for example, a will trust. HMRC, from a tax point of view, often view trusts in a bit of a dim light, and hence some of the changes that we saw back in 2006, mainly because they view them really as primarily being used for tax avoidance. However, I think you might agree there's a bit more to that than just the kind of cynical view. So the first kind of reason in our why slide today is control. So the creation of a trust enables the person making the gift, so the settlor, and we'll come on to these terms in a bit more detail shortly, to make a gift and attach certain conditions to it. So they're still making a gift, but with strings attached, if you like. The trust document itself will tell us how those assets are to be dealt with. The settlor will even be able to say who will benefit and to what extent, when and whether the trust property could actually be sold or used for certain purposes, and who might be able to benefit from it in the future. The day-to-day management of that trust property is of course the responsibility of the trustees, but the settlor, if they're still alive, could actually also be a trustee. Settlers can therefore kind of either remotely by the trustee or directly as a trustee themselves manage the property that they no longer own. So provided their decisions are made in the interest of the beneficiaries of the trust, of course, and in accordance with the terms of the fund. Okay, the second point here is protection. So thinking here of family wealth. So here some of the tax planning does come in, of course. So like making a lifetime outright gift, a gift to a trust can be used to protect some assets from tax, namely inheritance tax. We'll talk about different gifts into different trusts and how they're treated for tax in the fourth section today. So using a trust can restrict the amount and type of benefit received from the wealth or the property that's being gifted. So an example could be you want to assist your niece or nephew with their university expenses, but you don't want them to go off and spend all the money on a fast car, for instance. So a trust could be a sensible way of achieving that objective for a client. Also, in terms of protection, we can think about when someone's too young to handle their affairs, so a minor. Secondly, when a large gift just might not be appropriate for various reasons. And then thirdly, when someone's not actually able to manage their affairs because they don't have capacity. Okay, trusts are particularly relevant where the intended beneficiary of the gift is too young, as we've covered in that point. And by gifting the assets to a trust, a settlor can retain some degree of control over the assets that have been given away. When we're thinking about trusts for younger people as well, the settlor can restrict and control the flow of the income and the assets of the trust to the beneficiary as set out in the deed. And if so, the settlor will often play an active role by appointing themselves as a trustee to be able to do that. Thirdly, flexibility. So a trust can allow your trustees to adapt to circumstances as they arise. So if you made an outright gift, in contrast, you can't change your mind and give it to somebody else later, or arrange for it to be passed down in a different way. Another example could be a client has two adult children, so one who is already employed in a highly successful and highly paid job, and the other one is still in postgraduate studies, for instance. With a trust that's flexibly drafted, an income from a rental property, for instance, could be used by the trustees to benefit the child with little or no income at the moment, who's still studying. In later years, if that older child who is already in employment took a career break to raise a family, for instance, you could then look at switching it around, and the other child is earning a good salary, they finish their studies, the trust income could then be used to help with the cost of raising the grandchildren, for instance. So again, just offers that extra bit of flexibility. Okay, so moving on to who is involved in the trust. Now, we've mentioned these three parties already, but we'll just go into a little bit more detail. So the trust document itself will name the trustees, it will set out the beneficiaries, including any classes of beneficiary if that's appropriate, and the initial trust property or fund. So firstly, all trusts will have a settlor or settlor, depending how you like to say it. The settlor is the person who makes the settlement. So the person who transfers the assets to the trustees and then decides how they should be used initially. Sometimes the settler can also benefit from the assets in the trust. This would be known as a settler interested trust. And for this reason, it involves special tax rules and anti-avoidance measures to take away any tax advantage of doing that. So for the purpose of today, we will assume that our trusts that we talk about are not settler interested. Jumping to the third point here, when the trust is created, the legal ownership, as we've already talked about, of the property passes from the settler to the trustees. So trustees, like a company or an individual, are a separate legal person. They have a legal personality of their own, and that's separate from the individuals themselves that make up the body of trustees. So the trustees as a legal body will themselves have income tax, capital gains tax, and inheritance tax liabilities. Generally speaking, anybody can act as a trustee as long as they're mentally capable of doing so. The settler will specify in the trustees who are to be the who will be the trustees of the trust. Most trusts have a minimum of 2 trustees. There's no legal obstacle to the settler naming themselves as a trustee. We find in many family trusts, the settler will act as trustee alongside a professional, perhaps, such as a family solicitor. This gives them, as the settler, the power to have some say in how the income and the capital of the trust should be distributed. So settler acting as a trustee is, of course, distinct from them being able to benefit from the trust, which would make it settler interested. The trustees, as we've said, and keep hammering home, they're the legal owners of the assets in the trust. So their role is to deal with the assets according to the settler's wishes, as set out in the trust deed or the will, manage the trust on the day-to-day basis and pay any tax due, and decide how to invest the trust assets. Again, we're going to cover that in a bit more detail, particularly kind of the investment responsibilities in the next section. If the trustees change, then of course the trust can still continue, but there always has to be at least one trustee. So you might see a trustee retires and another one is appointed, usually by a deed of appointment. Okay, finally, beneficiaries. So within the deed, the settler will nominate the person or persons who shall be the beneficiaries of the trust. In general terms, the beneficiaries are the only persons who are entitled to use or enjoy the income and the assets of the trust. There, of course, might be more than one beneficiary, for example, a whole family or a defined group of people. A common one we see is, you know, my children, my grandchildren, and future grandchildren, for instance. Depending on the terms of the trust, the beneficiaries could be a beneficiary of the income only. They could be beneficiaries of capital only, for example, getting shares that are held in the trust when they attain a certain age, or they could actually benefit from both the income and the capital of the trust. This will always set out in the trust document itself. Again, as we mentioned before, the separation of the legal ownership and beneficial ownership is a key characteristic of the trust concept as a whole. And the trustees, you know, they owe a duty of care to the beneficiaries, in particular loyalty, to put their interests first. So those are the beneficiaries first above their own as trustees. Okay, moving on to trustee duties. Now, we'll include some detail on this in the guide itself, rather than list every duty on a slide, but we'll summarise some of those. So at a high level, a trustee owes duties of honesty, integrity, loyalty, and good faith to the beneficiaries of the trust. As I mentioned just now, they must act exclusively in the best interests of the trust and beneficiaries, and be actively involved in any of the decisions for the benefit of the beneficiaries. So when we're talking about kind of fiduciary duties, specific fiduciary duties towards the beneficiaries include, firstly, to always act in accordance with the trust deed. Secondly, not to make a profit from the position as a lay trustee. Thirdly, to avoid any conflict of interest between their own interests and those of the beneficiaries, as we already mentioned. Not to act to their own advantage or the benefit of a third person without the beneficiary's informed consent. And finally, to, of course, properly invest the trust property. And that's what we're going to kind of focus on a little bit now. So investment powers. So I've mentioned here the Trustee Act 2000 in England and Wales. Separate acts for other devolved nations, so the Charity and Trustee Investment Scotland Act 2005, and the Trustee Act Northern Ireland 2001 also apply here. When you see Trustee Act 2000 England and Wales, we are talking about the other two acts as well, and I'll point out a couple of differences shortly. So these three acts grant what we call wide investment powers, meaning that trustees can invest in any type of asset. Okay, before this, previous acts did actually kind of restrict what investments trustees could make, but now it's very wide-ranging. Okay, so although most modern trusts will refer to the investments allowed by the Act or the Act applicable, it's actually possible for the trustee to, of course, include some restrictions of its own. So it's clearly important to know where you've got clients who are lay trustees, that they understand what powers have been granted. In England and Wales, as I said, the Trustee Act 2000 applies, and that's introduced what's known as a statutory duty of care for trustees. Okay, so within that statutory duty, it also includes a duty to apply what's known as standard investment criteria, and a duty to obtain what's known as proper advice when making or reviewing investments. So just to dial into that standard investment criteria, the two main things are to ensure the suitability of the investments for the trust, again, so not dissimilar to what you'll be doing for individual clients. And then finally, the need for diversification of the investments of the trust, so as is appropriate to the trust and the type of arrangement that we have here. Okay, as I mentioned, the trustees have a duty to seek proper advice. Okay, so unless they can conclude it's unnecessary or would be hugely uneconomical to do so. In reality, most lay trustees would have to take investment advice unless they have the necessary qualifications themselves and the experience to do so. Trustees could, of course, just choose to delegate to a DFM, for instance. If they choose to do that, they must provide an investment policy statement. Just a quick note here, that's not actually a legal requirement of the Act in Scotland, but of course it's good practice to do so. So you often see many settlements doing that. Kind of other considerations to take when making investments will include, again, those similar to what you will consider for individual clients, just with an extra focus, if you like, on what payment might be required to beneficiaries and when, as well as some of the taxation aspects unique to trusts that we'll cover in the final section. So, for instance, the nature and the terms of the trust, the need for income or capital or both, which might be determined by the type of trust. As I mentioned, when payments are due to beneficiaries, the cost of administering the investment, and any tax reporting obligations, along with the kind of risk profile that you're looking at, the wider settlement. Okay, so moving on to those kind of last bullet points there. So some other, very key responsibilities and duties of trustees. Keeping accounts, proper accounts and records. Okay, so good records are a must. So that covers everything from the tax pool to general tax accounts, and they will help keep the trustees on course for completing tax returns and obviously making sure they pass on the correct and accurate information to beneficiaries. So, for instance, if they're making an income distribution, to make sure they properly report the tax consequences of that to beneficiaries, kind of a particularly key one in discretionary trusts, which we will come on to. Again, these records will include the income, but also the expenses of the trust. Obviously, distributing property to the beneficiaries. So if we consider a discretionary trust, the trustees will have power to accumulate income, so they don't necessarily have to pay it out as and when it arises. In interest in possession trusts, the opposite is true. So the income beneficiary would have a right to that income, and a right to it within a reasonable period of the trust's year end. So the beneficiary will need to have information along with the distribution to make sure they're completing their tax return properly. And we'll come on to kind of how interest in possession is taxed shortly. Finally, a fairly newer point, the trust registration service. Again, we'll cover some of this in the guide, but just at a high level, there is a legal responsibility for registration within the trust registration service, and that responsibility lies with the trustees. So who has to register? So trusts already in existence at the 10th of March last year, so 2020, must register by the 10th of March 2022. trusts set up after the 10th of March 2020 must register within 30 days or by the 10th of March 2022, whichever one's the latest. So therefore, trusts set up after the 9th of February 2022 have 30 days to register. Once registered, they have 30 days, so the trustees have 30 days to update the service with any changes that are required to the settlement. Okay, so here we're largely to date have been talking about trusts that have an income tax or other tax liability, but it's going to probably be moving to all settlements at some point. Okay, so moving on to our types of trust. So changes brought in by the relevant property regime in 2006, which was almost like a huge role change for trusts. A lot of us are very keen and aware of ADA and pensions that occurred in 2006. Well, it was also a big year for trusts and IHT reform in particular. So since 2006, trusts now set up will generally be discretionary or non-discretionary in the way they are taxed. So we've got 4 types, the main types that we're going to cover today. I'm sure most of these are very familiar to you all. So the plan is to go through the kind of main features and the uses of each of the types. So we've got discretionary trust, interest in possession trust, bare trusts, arguably sometimes not a full settlement, but we will be covering them. And then finally, trusts for disabled persons and vulnerable beneficiaries. Okay, so discretionary trust. These are what I would call the most flexible forms of trust. From the settler's point of view, so the person setting up the trust, a wide range of beneficiaries can be named, and as we mentioned before, also classes of beneficiaries. So for example, all my current and future grandchildren. Okay. Under a discretionary trust, and the clue's kind of in the name here, the crucial part is that the beneficiaries have no automatic right to receive any of the trust income or the capital, and they have no legal entitlement under the trust. Okay, the trustees here have legal ownership of the assets and full discretion over the distribution of income and capital. Crucially also, when income is received by the trustees for the trust, the trustees can decide whether to accumulate that or pay some or all of it out. Okay, the trustees have full discretion here. And again, they can decide who to pay out to and when and how much, or if not at all, they have the power to accumulate income. And that's crucial when we compare discretionary trusts with other types. We talked about protecting family wealth in the first section as a why set up a trust. Discretionary trusts are a popular way of achieving this objective for clients, particularly if there's, with the future generations of the family in mind. So the crucial thing here is the trust property would not be included in the assets of the beneficiary, so that has impact for consideration on future divorce, bankruptcy or death of the beneficiary. So again, it's a way of protecting family wealth for generations. Unfortunately, as we will come on to shortly, all of this flexibility does come at a price in terms of the tax treatments of these settlements. Okay, our second type that we're covering today is an interest in possession trust. So you might hear these referred to as life interest trusts. They can be set up with a lifetime gift or on death. So under a life interest or interest in possession trust, the trustees have no power to accumulate income within the trust. Okay, so under the terms of the IIP trust, the trustees must pay out the income to the named beneficiaries. So that named income beneficiary is often referred to as a life tenant or life renter in Scotland. And in a typical interest in possession trust, the life tenant will be entitled to that income for life, sometimes of a specific age or point in time, and thereafter the capital would pass to another type of beneficiary called the remainder man or a reversionary beneficiary. Okay. we sometimes hear it referred to as reversionary beneficiary because on the death of the life tenant, that trust capital reverts to that next beneficiary. Okay. Just to point out on that second bullet point, of course, it can be set up with a lifetime gift or on death. Now, on death, the IIP trust would be usually set up under the terms of the will. If the will doesn't provide for it, then a deed of variation can be used, or actually under the laws of intestacy, an IIP trust might arise. Typically, with trusts set up in wills, the surviving spouse is often given the right to the trust income for their lifetime, so or the right to occupy, for instance, a marital home, with the capital then passing on death to designated children. Where a IIP trust is created under the law of intestacy or a deed of variation, it's known often as an immediate post-death interest trust. So you might see that name. So that just means it's been set up under the deed or under the rules of intestacy. Now that last point, or the second to last point I should say, the trustees here. So when we're thinking about our trustee duties and our investment powers, they've got to match their duties here to both the life tenant, so the income beneficiary who's legally entitled to that income. It cannot be accumulated, it needs to be paid out. And of course, the reversionary or remainder capital beneficiaries when choosing investments. So here, you know, IIP trusts are a key area for investment advice. And finally, these trusts are now less popular for lifetime gifts. And the reason being that on that big rule change in 2006 that I mentioned, the relevant property rules, new interest in possession trusts, new lifetime trusts are subject to the same IHT regime as discretionary trusts. So previously they had slightly favourable treatment that I'll come on to in our tax section. So the use of IIPs for lifetime gifts at least has declined somewhat since those rule changes. Okay, bare trusts. Those of you who attended the Investing for Children webinar, I covered these there, but I will cover them again for today. So they are the simplest form of trust, okay? The named beneficiaries are fixed and absolute, fixed at outset and cannot be changed. So although future grandchildren or children can't be added when the trust is set up, new settlements could potentially be created for their benefit. So the beneficiary has a right or an absolute entitlement to the trust capital and any income generated from it. The bare trust itself could be established and run by grandparents as trustees. This is important because if parents, for instance, use their capital as settlers to make the gift, the parental settlement rules could jump in. I'll cover these in the next section, but it's an important consideration. And it's a popular way of grandparents perhaps making gifts for minors particularly. So that last point there, the beneficiary, because they are absolutely entitled to it, they can actually demand access to the capital at age 18 or 16 in Scotland. The trust can actually continue, but the beneficiary will need to have some details of income. And again, I'll cover that along with parental settlements in the tax section. Okay, our final type of trusts for vulnerable persons. So trusts are a really useful vehicle to protect the interests of vulnerable beneficiaries, and there is special tax treatment for certain trusts that are created for a disabled person or bereaved minor, provided certain conditions are met with who can actually benefit. So a trust for a disabled person could be created through the will of somebody wishing to establish a fund for their benefits, or this trust could be created by a lifetime gift of cash or assets. The rules to access the kind of more beneficial tax treatment that I'll talk about in the next section, they're really complex though, and a lot of the time the person who would like to make provision for a vulnerable person might want to consider whether the added complexity and the restrictions who can benefit from the fund or the residuary fund might mean that they actually just go with the normal discretionary trust, because the discretionary trust offers that flexibility, obviously at the price of the tax treatment. There's a balance to be made about the objectives for the fund both now and in the future. So as mentioned, they've been created through a lifetime gift, also through a will. But again, another type of trust could still meet the overall objectives. if tax isn't the kind of main issue with wanting to set up this trust for the vulnerable person. Okay, so moving on to taxation. Okay, I did promise a quick word on parental settlements. Okay, so this rule comes in where a child is entitled to income from a settlement, and that income is £100 a year per parent per child or more. The income will be treated and taxed as the parent's own. So the main way you might see this happen is if a parent set up their trust, for instance, for their child, and that settlement created income of more than £100 per year for that child, then it could be caught by the parental settlement rules, and rather than be treated as the child's income and be able to use their allowances that we'll talk about in the upcoming slides, it will be taxed and treated as the parent's own. Okay, so the last point here, it does not apply to grandparents, so that's what I was talking about in the context of bare trust again. If the grandparents provided the capital, it was their capital, the parents could still be the trustees of that bare trust settlement, no problem, but it would not apply to settlements created by grandparents as settlers. Okay, so just one thing to bear in mind. Okay, so moving on to taxation of our specific tax types. So we're going to start with the most difficult one, discretionary trusts. And firstly, we're going to consider inheritance tax. So when the gift is made into the discretionary trust, it will be a chargeable lifetime transfer, or CLT, if you like acronyms, for IHT purposes. So any value of the gift plus any other CLTs made in the previous 7 years will be added together, and if that's more than the value of the nil rate band, so nil rate band today is £325,000, any excess over this amount will be chargeable to inheritance tax, but at the lifetime rate of 20%. Annual exempt amounts could be available, so our £3,000 a year annual exempt amounts, you can use the current year and the previous year if it was unused by the settler, so that could cover up to another £6,000 of the value of the gift. So that's a good one to kind of remember and keep in mind. Additional complications, if the settler died within 7 years of creating the trust, so making the gift becomes chargeable, and any potentially exempt transfers, so pets, different types of gifts that become chargeable, become failed pets, if you like, because they were made also in 7 years of the settler's death, will also be considered. So it's just one thing to bear in mind. There would be credit due if your client had paid or suffered lifetime rates IHT of 20% against any liability on their death, but nothing over that amount can be reclaimed if the actual final tax due is less than what was paid in their lifetime. Okay, periodic and exit charges may apply. So periodic charge would be an assessment to IHT every 10 years. So in sort of general terms, the value of the trust less the nil rate band available to the trust will be calculated. Any excess amount will be subject to tax at 6%. So if the value of the trust itself is less than the nil rate band, no charge will apply. That's simplifying it somewhat. We won't be going into great detail on these charges today because they can get really, really complex. If you're worried that these might apply, my suggestion would strongly be to involve a tax solicitor or an accountant that specialises in this area, because it is quite a difficult one. Just to cover off exit charges, that's a charge, an IHT charge, that's calculated when capital, so not income, but capital is distributed to the beneficiary. So there's an exit of capital from the trust. Generally speaking, as a kind of rule of thumb, if no lifetime tax was due on that initial gift, on our initial CLT, there's not normally any IHT due on the distributions made in the first 10 years. There's other special rules that apply to will trusts and distributions that are made from them in 2 years from death, and those exit charges do not normally apply. But again, as I say, that's a really complicated area that we're not going to have time to go into today. Okay, secondly, capital gains tax. So we're talking here about capital gains tax on the way into the trust itself. So transferring existing funds, so unit trusts or OICs, for instance, excuse me, into a discretionary trust might trigger a test for capital gains tax. However, holdover relief might be available. So that's one consideration if it's hold over that pent up gain on gifts of certain assets. If we're talking about assigning investment bonds or cash gifts that are made to the trust, they won't count as disposals, so there would not be a capital gains tax liability triggered. When we're talking about the assets of the trust being sold, once they're in the trust, the process for calculating gains is the same as it's for individuals, but any tax will be paid at different rates. So there's different rates for trusts. They are 20% generally, or 28% where we're talking about residential property. So 20% for all other assets, 28% for gains on residential property. Another thing to note is that the trustees are entitled to an allowance for capital gains tax, but it's half of the usual amount for individuals, so £6,150 for trusts. One thing to be aware of, that is divided by the number of settlements that the settler may have made. Okay, so if this person who created the discretionary trust also created other settlements, you then start to divide up your CGT allowance. So it could actually be smaller than 6,150. Okay, and then finally, when we're thinking of CGT sort of on the way out, if you like, if the trustees did make a payment of capital to the beneficiary and transferred assets to make that payment of capital, there'll also be a disposal for CGT. Again, there's another chance to use holdover relief if the trustee and the beneficiary elect to do so, and then that potentially postpones that gain until the beneficiary then sells the asset once they. Okay, so next, income tax of discretionary trust. So this is a major change also over the years. So income that's received, say, from a unit trust or a fund, OIC fund held in discretionary trust, will be taxable upon the trustees. So will interest from cash deposits and savings, and so will rental income from properties. Okay, so basic rate tax at the trustee rate will apply to the first £1,000 of gross trust income. Okay, so that's our standard rate band. So there's no allowances for trustees in the same way there are for individuals, like our personal allowance or a dividend allowance, but there is a standard rate band at which the tax that arises is taxed at slightly lower rates. This is because when the relevant property regime came in, there were obviously a number of small discretionary trusts in existence, and kind of tax professionals lobbied HMRC to get the standard rate band put in, because the change would have just been so punitive for these small settlements that generated, small amounts of income. So there is an order of tax for this standard rate band, like there is for you and I paying tax personally. So non-savings income first, so our rent income, for instance, then savings income such as interest, then dividends. Okay, so anything in excess of that standard rate band will be charged at the trustee rate, so the equivalent additional rates as if we were an individual. So as you can see from that table, above £1,000, dividends would be taxable at 38.1% and all other income at 45%. So similar to our additional personal rates. Again, if the settler has created more than one settlement, that £1,000 standard rate band will be split equally between each settlement. Okay, subject to a minimum down to £200 per trust. So if they'd actually set up 6 settlements, it's still £200 per trust, not £1,000 divided by 6. As I mentioned before, no dividend and personal savings allowances are available to trustees as they are to us personally. A quick word on investment bonds. Okay, so there is no income tax charge unless a chargeable event occurs. This is because investment bonds, as we know, are not deemed to be an income producing asset. So if a chargeable event did occur and the bond is owned by the trustees, a gain will be assessed to income tax on the settler if they're still alive and UK resident. in the same way as if they owned it as an individual. So there would be top slicing available as well. If the settlor is not alive and it's not the year of their death, the trustees will be liable. So what could happen is the liability to tax following the chargeable event could be transferred to the beneficiaries if the trustees were looking to make a capital distribution from the trust, and they could do this by assigning segments to the beneficiary. The gain on subsequent surrenders would then be assessed on the actual beneficiary themselves, personally, again with top slicing relief available. So that is one avenue to explore for certain beneficiaries. Again, as I mentioned before, special rules apply to settlor interested trusts and parental settlements, as we've already covered. For the latter on parental settlements, have another look at the guide, or we actually have them covered in our Investing for Children guide as well. Okay, moving on to income tax in the hands of the beneficiaries. So when income is paid to a beneficiary, it's deemed to be trust income for tax purposes. That's regardless of the source. So here we say it has no deemed source. So even if they ultimately came from dividends rather than rental income, it's just deemed to be trust income, and for that reason it's deemed to have been taxed rather of 45% and is paid with a 45% tax credit to the beneficiary. So it's probably best demonstrated by our example on the green box here. So if our beneficiary received £2,750, that's net income from the trust. So it's paid with a credit of 45%, which is our £2,250, and the actual gross amount that's deemed to have been distributed from the trust is £5,000. So all of this information is shown on what's called an R185 form, which the trustees need to give the beneficiary. So it will detail the net income, the value of the tax credit, and also the gross income distributed. And the reason for this is because the beneficiary could then potentially claim any overpaid income tax based on their own marginal rates. So if that beneficiary was a non-income taxpayer, they could actually reclaim the whole £2,250 tax credit. If they were a basic rate taxpayer themselves, they could reclaim £1,250 there. Okay. Again, we've mentioned beware of the settlor interest and parental settlements rule. I've also mentioned the tax pool there. So again, it's quite a lot to go into for today. We will put some information in the guide, but briefly, trustees will keep a record of income tax paid in what's known as the tax pool. Okay, so as we talked about on our previous slide, the trustees could have paid tax at any number of rates, so 7.5%, 20% on that first £1,000, as well as the higher rates, so 38.1% for dividends and 45% for other income. But each time they make distributions to beneficiaries, they've got to have enough in that tax pool to cover the 45% credit. So as I mentioned before, all income passed to the beneficiary is treated as not having a deemed source, and it's paid with a 45% tax credit. We might run into slight problems if you're looking to distribute all the income to beneficiaries, but all or most of your income has come from dividends, because the trustees haven't actually paid 45% on every single bit of that dividend income. Okay, they would have paid a bit at 7.5% and a bit at 38.1%. So there would actually be, if you were looking to distribute all of that income and it only come from dividends, there would be a deficit between what tax is actually being paid and accounted for in the tax pool and the credit that's been given to the beneficiary. Okay, so HMRC are not going to make up the difference between the tax they've received from the trustees and the tax credit the beneficiaries are deemed to have had, because that would be them making some kind of gift. So, you know, there would be a need in that situation for the trustees to actually make up the difference in tax. Okay, so what we normally see is trustees accumulating some of the income, not paying every single penny out, and then just, you know, properly allocating and accounting for that tax pool. Okay, so moving on to interest in possession trusts and how they are taxed. So with IIPs, the inheritance tax treatment actually depends on whether it's known as a qualifying interest in possession or not. Now, that depends on whether the trust is created in the settler's lifetime or on their death. But also for lifetime trusts, the crucial issue is whether the trust was created in the settler's lifetime before or after our 22nd of March 2006. Okay, so just zoning in on lifetime. So since the 22nd of March 2006, so since our relevant property regime came in, the IHT treatment of interest in possession trusts is the same as discretionary trusts. Okay, so we've got our chargeable lifetime transfers on gifts in, excess over no right band charged at 20%. Again, periodic and exit charges might actually also apply. However, before 22nd of March 2006, it should say there, the interest in possession trust would be what's known as a qualifying interest in possession. The initial gift would have been a potentially exempt transfer, so a PET, not a CLT, and the ultimate value will form part of the life tenant, so our income beneficiaries' estate on their death. Okay, so interest in possession trust set up on death will be a qualifying interest in possession. Again, usually be a chargeable transfer, but a spousal or civil partner exemption would apply. Okay, so it would be deemed to be a chargeable transfer by the deceased on their death unless that spousal or civil partner exemption applies. Again, interest in possession trusts that are set up on death are not treated as relevant property, so the trust would not be subject to any periodic or exit charges. Again, instead, the value would form part of the estate of the life tenant on their death. Again, moving on to other tax treatments, the same as discretionary trusts here, and holdover relief might be available on the initial gift. Here, the main difference with IIPs and discretionary trusts is income tax on the trust. So as we mentioned before, the life tenant or the life renter, sometimes referred to in Scotland, is entitled to the income from the interest in possession trust. And there's two ways really that the trustees can choose to deal with income. So the first and probably generally more popular that we certainly see is that the income is mandated to the beneficiary. So as the income arises, it's just paid out straight to that beneficiary personally. And the reason that you might do that is that it's then taxed at the beneficiary's own rates. Okay, so personal allowances will be available, which could be quite valuable if you've got a non-taxpayer or a very low taxpayer. The downside here for the trustees is there's no expenses that are deductible. Okay, so if it's mandated straight out, there's no opportunity to deduct expenses. So our second kind of way of dealing with income tax is the trustees could deduct expenses and account for and pay income tax at the basic rates. So that would be our 7.5% on dividends and 20% tax on other income. As I say, normally you kind of do see that first mandated income used. Again, beware settler interested trusts and parental settlement rules could apply here because the life tenant is entitled to the income. Okay, so if the life tenant was a child and the trust had been set up by parents, again, it could be caught from the parent settlement rules. Okay, moving on to bare trusts. So again, more simple form of arrangement. So the gift itself is a potentially exempt transfer or okay, so although there's no kind of limit to what could be paid into a bare trust for a child, there are obviously still IHT considerations to be aware of. The assets then form part of the beneficiary's estate. Okay, so as we mentioned before, the beneficiary has a right, so an absolute entitlement to the trust capital and any income generated from it. This means that the child's own allowances can be used. So own allowances for income tax, individual allowances, and own allowances for capital gains tax, rather than any trust rates. So income and gains for a child could actually be tax-free if these allowances are not exceeded. Again, I need to point out parental settlement rules that apply. So if the bare trust is created by a parent and the income generated from the trust is more than £100 per year, it is likely it will end up being taxed and treated as the parent's own, therefore negating any kind of tax benefit of this. In terms of access, I think we touched on it earlier, but at age 18, the beneficiary reaches majority and is able to demand access to the capital. It can be signed over to them if you like. Age 16 in Scotland. The trust can actually continue if the beneficiary is happy to do so once they reach majority. Some people do continue to run it this way. However, because that beneficiary has now reached majority, they will be responsible for declaring the tax payable and paying any tax due. So the beneficiaries need to make sure they are the trustees need to make sure they're telling the beneficiaries all the details that they need to know about income paid out and disposals made, so that they can complete their own tax records accordingly. Okay, if the beneficiary did decide that they wanted to take full ownership and demand access to the capital, they can do so, and obviously the trustees must pay it to them. As the beneficiary is treated as having been owning this property throughout the bare trust being in existence, there's no disposal for CGT purposes at that point. So say we had a basket of investment funds, unit trusts and OICs, and the beneficiary took ownership, or took management, I should say, not ownership, management of them at age 18. There's no disposal because they've already been treated as owning them themselves that whole time. Okay, the beneficiary themselves would acquire the original base cost of the investments for their own records. Okay, our trust for vulnerable persons. So I mentioned there was some qualifying conditions that need to be met. We're not going to outline those exact conditions, but if they are met, the tax treatment could be as follows. So potentially exempt transfer on the initial gift, so a pet. Again, not subject to IHT, periodic and exit charges. So that, potentially a significant advantage to the tax treatment over discretionary trust, but those qualifying conditions are quite strict. The trustee could also elect for income and gains to be taxed at the vulnerable beneficiary's own rates rather than normal trust rates. So that would mean, for instance, the full CGT annual exemption would be available, along with the income tax personal allowances, and trust that up for disabled people are entitled to the full CGT annual exemption anyway, rather than the lower trust amount. But those first 3 points, are the potential tax advantages of setting up a qualifying trust for a vulnerable person or vulnerable beneficiary, but those qualifying conditions are very strict. Okay, so that brings almost to an end our session today, and finishing on the tax treatment seems a little harsh on reflection. And I just wanted to, in kind of final thoughts, mention some other trust types that you probably know and deal with well. So we've got things like discounted gift trusts and loan trusts that you might have expected to hear about in the types of trusts. So really, these arrangements could actually fall into any of the 3 main types of trust. So they could be absolute, they could be discretionary, they could be interest in possession. But largely, I would refer to DGTs and loan trusts more as estate planning solutions that sort of sit on top of these main underlying trust types. So loan trusts, for those who aren't aware, it's IHT neutral really, because it's a loan rather than a full gift, including in the name there. What does happen is the future investment growth from that loan is outside of the estate rather than the whole value of the capital gift itself, potentially. Again, discounted gift trusts, so they're arrangements that give the settlor, so the person making a gift, a discount on the IHT value of the gift itself, but the kind of exchange they get for that is that they must take fixed payments back into their estate from that gift. They can't pause those. I also just wanted to mention personal injury awards. So here, somebody for suffering a personal injury might receive compensation that can be held in a trust. So the injured party must be a beneficiary of the trust. Again, it could fit into, excuse me, one of our 3 types, so our discretionary, IIP or bare trust. And of course, that could affect the tax treatment of the compensation award. In some cases, the personal injury trust could also meet the qualifying conditions for a trust for a vulnerable beneficiary or disabled person. Basically, personal injury trusts are required if there's no court-appointed deputy and the beneficiary lacks capacity or is a minor. So that's when you might see those. And I know some advisors obviously specialise and deal with settlements generally for and on behalf of court-appointed deputies for their clients as well. So the reason, again, that might use a personal injury trust is not necessarily a tax planning, but more protection. So protection of the beneficiary's entitlement to certain mean tested benefits, for example. Okay, so here are our 4 sections we've covered today. We have covered quite a lot of content in our time together. So thanks for staying with me on it. So we've covered the kind of what, why, and who. So what a trust is, why somebody might set one up, and who is involved. We've covered the trustees' duties, so we've covered some fiduciary duties along with the main investment considerations that need to be taken into account. We've covered 4 main types of trusts, and we've also covered their taxation. So that brings me to, like I say, the end of today's session. Thank you for bearing with us. Any questions, do let us know in that question box, or as part of an email, or once you receive your CPD certificate and your feedback form. So all that remains is for me to say thank you and goodbye.